Welcome to this session. My name is Barbara Buchalia, and today we are continuing from where we stopped last time. We are looking at money supply and money demand. So let's look at the functions of money. Money is a medium of exchange. It can be used in exchange of goods and services, right? So with money, with barter trade, it has a limitation of double coincidence of wants, which is not the case with money. Double coincidence of wants with barter trade means that for the two parties, each party must have a particular commodity, for example, that they have to exchange for the other, right? So this is not the case with money. Then money can be used as a measure of value. Measure of value means that, for example, if you want to attach how much worth a commodity or a service is, its worth will be measured in terms of money or in monetary terms. Then it's also used as a store of value. Store of value means that, for example, if you have a perishable good, but you want to keep it, you want to have that perishable good to stay long enough, for example, in future, you can sell it and get money and then keep that money. And in future, when you need that perishable good, you just have to buy it. So indirectly, you have stored that perishable good. So that's what we mean by money being a store of value. Then money is a standard of deferred payment. Standard of deferred payment means that that people are able to borrow. If someone does not have money, they are able to borrow and get money, right? So for people that do not have money at specific moments, they are able to borrow and from either banks or individuals, and then they'll be able to get money for use. That's what it means by standard of deferred payment. Then money acts as a lubricant in the price mechanism. Even when we are attaching prices to goods and services, we are attaching them, the price is the money itself. The price will be specified in monetary terms. For example, you will say that such and such a good has a price of, let me say, $1,000. So the price is in monetary terms. So that's what we mean that money acts as a lubricant in the price mechanism. Then money creates friendship and harmony between sellers. On a number of instances, we realize that the friendship, even people that have maybe had got misunderstandings with money, they are able to reconcile, right? So let's look at money demand. Money demand. So with the money demand here, basically, we mean the desire that people have to hold money balances, either to hold the money balances or to deposit that money, in banks, right? So the general, the nominal output, as money increases with the level of nominal output, then it means that the nominal output or the nominal value for money will be given by the price level times the real output, right? And the real balances of money will be got by dividing the nominal output by the price level. So I think we had looked at the quantity theory of money. we had looked at the quantity theory of money, where we saw that according to Professor Irving Fisher, the quantity theory of money states that MV is equal to PT, where M stands for the quantity of money in circulation, V stands for the velocity of circulation, velocity of money supply or velocity of circulation of the money. The P stands for the price of goods, and T stands for the number of transactions that take place. So at the end of the day, the quantity theory of money, according to Professor Irving Fisher, is MV being equal to PT, right? So according to this theory, there is a direct or a positive relationship between M and P, or between money supply, or the quantity of money in circulation, and the price of goods, and the price of goods and services. In other words, with this quantity theory of money, when there is increase in money supply, this will lead to increase in prices. This will lead to increase in prices, literally meaning that increase in money supply leads to increase in prices, which increase in prices, if it is persistent increase in the general price level, it will be inflation itself. So let's look at the criticisms of the theory. This quantity theory of money, according to Professor Irving Fisher, does not explain how a change in money supply changes the price. So it simply tells us that when money supply increases, then the prices will increase, but it doesn't explain the logic behind that. And this theory is static in nature, in a way that it does not provide for adjustments. In other words, if adjustments are made, like we are going to see, for example, if adjustments are made by the through different policies, like the monetary policy and the fiscal policy to control money supply, the increase in the prices as a result of increase in money supply can be regulated, right? So this theory does not provide for adjustments or changes. Then in this theory, it regards P, or price, to be the only passive factor, and yet this is unrealistic, because it does not affect output. So it is silent. This theory is silent about the the number of transactions. It's silent about the T. It is silent about the velocity of circulation of money. And the theory only assumes that it is increase in money supply that affects the price level, rather than, and yet also it can happen that the price levels, that increase in the price levels can increase money supply. It can happen the other way around. Let's look at the motives of holding money. Why do people hold money? Why do people hold money? So according to economics, there are basically three primary motives or reasons why people hold money. Number one, as transaction motive. People hold money because of transaction motive. So transaction means that money in this perspective is used as a medium of exchange for making transactions. Practically, if you want to buy a good, if you want to attain a service, you'll have to use money. So people hold money for transaction, because of transaction motive. Secondly, people hold money because of precautionary motive. Precaution means that if here people are basically preparing themselves for contingent moments, for contingency. For example, you don't know what will happen in the future, so you keep your money because of contingencies. Because, for example, it can so happen that maybe in future, maybe you fall sick. You don't know if you fall sick in future. So you keep this money such that, for example, if you fall sick, you'll be able to use this money to treat yourself for unexpected occurrences in future. In other words, precautionary motive. Then People hold money because of speculative motive. Speculative comes from speculation, right? So with speculation, practically, if you can look at speculators, these are people, for example, that hold assets, yeah, of course, financial assets. And of course, we know that these financial assets, they attain interest on them. So people can hold money. Of course, the interest rate on these interest-bearing assets affect the rate at which people hold money. Of course, if the interest rate on these financial assets is high, it means that people will hold less of the money, but rather they will invest this money in the interest-bearing assets. Whereas if the interest on these interest-bearing assets is low, people will hold more of the cash balances. All right, let's look at the factors influencing the demand for money. Number one is the price levels. If the price levels are high, then it means that people will that people will hold more money, right? If the price levels are high, it means that people will hold more money, right? Because they need this money to carry out the day-to-day transactions. In other words, with the high price levels, for example, in moments of during periods of inflation, it means that there is increase in aggregate demand for goods and services, and therefore people will demand more of the money. People will have will actually have more of the cash balances into their hands, because in this perspective, goods and services are expensive. People are withdrawing money from their banks to make sure that they meet these expensive expensive costs, right? Whereas if the price levels are low, it means this reduces the aggregate demand for goods and services, and therefore people will hold less of the money in terms of cash balances. Then another factor that influences the demand for money is income. Of course, keeping other factors constant, the more the income levels of individuals, the more they hold more money, right? The more cash they hold, right? Whereas with when they have low income, then they will, of course, they hold less cash with them, right? Or less money balances. Interest rates. So these interest rates are of course, like you've already seen on the interest-bearing assets. If the interest rates on the interest-bearing assets are high, then it means people will hold less of the cash balances, but rather invest in the interest-bearing assets, right? Whereas if the interest rates are low, people will on these interest-bearing assets, people will hold more of the cash balances. People hold more of the cash balances. Alternatively, it can be interest rates on loans, whereby if interest rates on loans are low, then it means this encourages more people to borrow money. It encourages more people to borrow money, and therefore it means that people hold more money balances than when the interest rates on loans are high. Because if interest rates on loans are high, it discourages borrowers, it discourages people from borrowing money, and therefore people will hold less money balances. Credit availability. We can look at credit in terms of loans, whereby if the loans are readily available to the borrowers, then it means that these borrowers, it will be easier for them to borrow money from for example, from commercial banks, and therefore it will hold more cash balances or money balances than when there is no access to credit facilities or to credit itself or to loans. All right, it could be bank loans. So the relationship between the four factors that we've seen that actually affect the factors that affect the demand for money is summarized in a way that if interest rates rise, people tend to hold less money if interest rates rise. For example, if interest rates on loans, on bank loans increase, people hold less money because this discourages them from borrowing money, right? Or borrowing, getting those loans, right? Then if, for example, we've already seen that the price levels, right, also affect the demand for money, or why people hold the demand for money. So we've seen that when prices rise, or when there is a inflation is the persistent increase in the general price levels in an economy. So if there is inflation or the persistent increase in the general price levels, people will tend to hold more money. Why? Because when there is inflation, there is the increase in aggregate demand for goods and services, right? So people hold more of the money balances. Then we've already seen that another factor that affects the demand for money is the level of income, and we've seen that keeping other factors constant, when the income of people increases, they tend to hold more money than when their income levels are low. Other factors that affect the demand for money include the following: wealth, right? Wealth. People tend to keep more money in cash, but this is usually, for example, wealth can be in non-monetary terms. For example, if someone has land, owns property, or owns land, owns animals like cattle, goats, right? That is wealth, right? Wealth. So with wealth, people may want to keep may want to have more wealth, right? In terms of property, rather than non-monetary terms like property, land, and so on, animals, and instead of holding the real cash balances, right? So if people desire to hold more wealth than the cash itself, they will keep their money in terms of wealth, in terms of property. Then level of technology, right? So with the level of technology, where we see that people are literally using cards, they're literally using credit cards, they're using those ATM cards to keep their money. So literally meaning that they are holding, if they of course, the higher the level of technology, the less people are holding, the less people will hold the cash balances. For example, nowadays people keep money on phone. They are no longer moving with the real cash itself, right? So that is because of increase in technology. And another factor that affects the demand for money is the brokerage or transaction costs. I believe your brokerage or transaction costs. For example, here we can look at the transport fares, the day-to-day transport fares that people use to board maybe a taxi, right? So all those ones are in what we call transaction costs. So of course, at the end of the day, if these for example, the transportation costs are high, people will tend to keep more of the cash balances. Of course, we know that when these transaction costs are high, it will lead to prices, especially transport costs increasing. If they are high, it leads to increase in the prices of goods and services, which in the long run, if not controlled, we shall have scenarios of inflation, and thereby having increase in the aggregate demand for goods and services, and thereby, of course, this will be a scenario of inflation whereby people will hold more cash balances. Of course, contrary to when the brokerage or the transaction costs are low. Let's look at the tools of the monetary policy, the tools of the monetary policy. Now, the monetary policy is I should say, it is a measure that is used by the central banks It is the measure that is used by, one of the measures is actually a measure that is used by the central banks to regulate money supply, to regulate money supply, right? To regulate money supply in the economy. So this monetary policy has a number of tools. It has a number of tools, but we shall look at practically 4, right? I mean, they are basically 3, but we shall be explaining these tools, what each of them means. So it has a monetary policy. These the central banks use these instruments. They are called monetary policy tools or monetary policy instruments. So we have what you call OMO, not the detergent, but OMO, open market operation. Then the central bank also uses the bank rate. It uses also government deposits. It uses moral suasion. It uses a moral suasion, and there is another tool here that is called legal reserve requirement. Legal reserve requirement, which is also called the LRR, legal reserve. You can include that in your notes, right? Legal reserve. So that is the goodness with attending class, is that some of these things, they may not be readily in your notes, but you'll get them in class. Legal reserve requirement. Legal reserve requirement. So we are going to see how the central bank uses each of these tools. Legal reserve requirement. So let's look at the first tool, this tool of the monetary policy, which is called the open market operations. Now, it's called open market operation because it involves trading in securities. So what happens is that here there can be 2 scenarios. There can be a scenario where we have high, right? We have excess. I can call it excessive money supply or excess money supply in the economy. We can have a scenario where we have excess money supply in the economy, right? Excess money supply in the economy. We can also have a scenario where we have low money supply in the economy, where we have low money supply in the economy, right? So for each of these scenarios, the central bank will use the open market operation to solve any of these scenarios. For example, in periods when we have excess money supply, what will happen is that these will be periods of course, excess money supply increases aggregate demand for goods and services. Why? Because in this perspective, there will be a lot of money chasing a few goods. There will be a lot of money chasing a few goods. And if nothing is done, if there is excess money supply in the economy and nothing is done to increase the supply of goods and services in the economy, then what is going to happen is that there will be increase in aggregate demand for goods and services. There will be increase in aggregate demand for goods and services because there will be a lot of money chasing a few goods. And in that perspective, of course, when there is increase in aggregate demand for goods and services and the supply is not being increased, the prices will increase. The prices will automatically increase, and we shall have a scenario of the economy will be experiencing inflation, which is the persistent increase in the general price levels, which is the persistent increase in the general price levels in an economy. And of course, inflation is not a good situation because it leads to negative consequences like the currency losing its value, the currency losing its value, right? Or depreciating. So in this perspective, in terms of excessive money supply, or in terms of inflation, the central bank uses this open market operation tool or instrument by selling. It sells securities during times of inflation. The central bank sells securities. And what are these securities? These securities, for example, include bonds and treasury bills. Bonds and treasury bills during times of inflation or during times of excessive money supply. The central bank sells securities like bonds and treasury bills. Now, what are bonds? What are treasury bills? These are simply a bond is a non-bank loan. A bond is a non-bank loan. In other words, it's a loan that it's not given by a bank. A company can give you a loan. An individual investor can give you a loan, but on course, at the end of the day, you'll have to pay interest on that loan, right? You'll have to pay interest on that loan. But the only difference between a bond and the treasury bill is that the bond is long term. The bond is long term, whereas the treasury bill is a short term loan. A treasury bill is a short term loan. Now let's look at why does the central bank sell securities during times of inflation or during times of excess money supply? The logic is very simple. Because when you sell, for example, these bonds, they are the documents, right? Paper documents, right? But they are non-bank loans. When you sell something, in return, the buyer is paying you money, right? So when the central bank sells these securities, in return, these people that are getting these bonds, that are buying these loans, are giving it money. They are paying it money. And the essence of it being paid the money is to retrieve that money from the hands of the public, Remember, it has been now, the money supply has been in excess. So when the central bank sells the securities like the bonds and treasury bills, in return, these, for example, private investors that are buying these bonds are paying it money, and of course, it is retrieving money from the hands of the public. So at the end of the day, this will help to reduce money supply. It will help to reduce money supply. That is the essence of the central bank selling securities during times of inflation or excess money supply. And during times of low money supply, or during times of deflation. A deflation is a period where we have low prices, right? It is an opposite of an inflation. And the recession, we are in periods where we have recession. Recession is a period of low economic activity. Recession is a period of low economic activity, and because of low economic activities, the prices will be low. The prices will reduce. We shall have low prices, and we shall have a recession will also be characterized by periods of inflation. Yeah, at a certain time during a recession, we shall experience periods of inflation, right? Periods of characterized by periods of inflation and periods of unemployment. This has happened during the lockdowns. during the COVID-19 pandemic lockdowns, where the economic activity has been low, where we've been having periods of inflation. We've been where, for example, the transport fares have been doubled. We've had periods of unemployment where people were not working. They were restricted, their movements were restricted. And basically that was a period of a recession. So during such periods, it means there is low money supply. There is low money supply in the economy. And in this perspective, the central bank will totally do an opposite of what happens when there is excessive money supply. So during periods of low money supply, the central bank, what the central bank does is that it buys securities. It buys securities. It buys these securities. It buys the bonds and the treasury bill. And what will be the essence of buying these bonds and treasury bills? When you buy these, they are papers, right? They are papers, but they represent a loan, right? A non-bank loan. So when it buys these bonds, of course, when you are buying something, in return, you pay money to the people that you are buying from. So literally, it is, for example, buying from private investors from the economy, and in return, it is paying them money. Of course, it is now injecting money into the hands of the public to increase money supply, which has initially been low, And of course, the money supply has to be increased up to that point where we shall have an equilibrium. In other words, the supply of this money has to be at an equilibrium. It has to be at an equilibrium. Actually, in the money market, what happens is this. In the money market, what happens is this, is that in the money market, the money supply curve will be vertical in nature. That will be the money supply curve. It will be vertical in nature, and the money demand will be the normal demand curve. The normal demand curve we know, and the point where they intersect will be a point of equilibrium. So literally, this is money demand and this is money supply. So literally, the money supply, the point where the money demand equals the money supply will be a point of equilibrium in the money market. So that's how it is expected to be. Otherwise, if we have excess demand for money, the demand for money is greater than the supply for money, we are going to have a disequilibrium, which is not good, right? Which is not good. Of course, when we have excess supply of money, at the end of the day, we are going to have inflation. If we have low supply of money, we are going to have scenarios of a recession. So literally or practically, that is how the central bank uses that monetary policy tool or monetary policy instrument called the OMO, the open market operation. The open market operation. The second tool of the monetary policy is what we call the bank rate. The bank rate. It is called the bank rate, or it is also called the discount rate. You can call it the bank rate, but it can also be called the discount rate. The discount rate. And this discount rate or this bank rate is the interest rate by which central banks offer loans, by which central banks give loans to commercial banks. Did you know that central banks also give loans to commercial banks? Yes, they do. And that interest rate by which the central bank give loans to commercial banks is called the interest rate or the discount rate. So what happens? During periods? Of course, here we are looking at two scenarios. We are looking at the whole essence here for these monetary policy instruments or tools is for the central bank to regulate money supply in the economy. So during periods of excess, still the logic is the same, is that during periods of excess money supply or during periods of inflation, excess money supply, or during periods of inflation, what happens here is that the central bank now will work towards reducing money supply. And how does it reduce money supply? It is going to increase the discount rate. It increases the bank rate. The bank rate, it is also called the central bank rate, the CBR. So during periods of inflation or excess money supply, the central bank increases the CBR, or the central bank rate. It increases that interest rate by which it is giving loans to commercial banks. And the whole essence is to make it difficult for commercial bank to borrow from the central bank. And once it makes it difficult, of course, now this reduces the reserves. It reduces the reserves with the commercial banks. And also these commercial banks now, they will increase, they will in return, they will increase their interest rates that they the interest rates on loans that they do offer to their borrowers. So when the commercial banks increase the interest rates on loans that they offer to their borrowers, it also becomes difficult, or it discourages borrowers from borrowing from these commercial banks, because these commercial banks would have increased their interest rates on loans. So as a result, of course, by discouraging borrowers from borrowing from commercial banks, it in a way regulates, it discourages, or it regulates, or it prevents the extra increase of money supply in the economy. So in that way, the central bank would have, it helps to reduce the continual increase in money supply in the economy. The second scenario is when we have low money supply in the economy, or for example, during a period of recession, when we have low economic activity, high unemployment levels, even periods of inflation. Of course, with the recession, we have high periods of inflation, high periods of unemployment, and low money supply, as well as low economic activity, like what the period has been in the lockdowns, during this COVID-19 pandemic period, right? So of course, after the lockdowns, the central banks now should be now boosting the economy by increasing money supply. And how do they increase money supply? They increase money supply by totally doing the opposite of what happens during excessive periods of excessive money supply or periods of inflation. So the central bank will now reduce the central bank rate, or it will reduce the discount rate. The essence of reducing this discount rate is to encourage commercial banks to borrow from the central bank, is to encourage commercial banks to borrow from the central bank. And this, of course, now increases the reserves with the commercial banks. Literally now, here it means that at the end of the day, it will encourage the commercial banks will reduce their interest rates on the loans they are giving out to the borrowers, and this will encourage borrowers to get loans from these commercial banks. And of course, when they get these loans, of course, this is in one way, it is leading to increase in money supply in the economy. Of course, now to increase the money supply that was initially low during the time when the economy would have been experiencing a recession, where there is low money supply and low economic activity in the economy. So I believe that we are getting the logic behind this monetary policy instrument called the bank rate, and how it is regulated, or it is carried out by the central bank. Then we have what we call the prime rate. The prime rate is the interest rate by which commercial banks get loans from themselves. The prime rate is the interest rates by which these commercial banks lend themselves money, right? Then we have the third monetary policy instrument or monetary policy tool, which is called the legal reserve requirement. The legal reserve requirement, which is also called the LRR, the LRR. And the legal reserve requirement, basically here, it means that for every deposit that the clients of a commercial banks, with every deposit that the commercial bank clients make to this bank, the commercial bank has to make has to pay a proportion of that deposit with the central bank. For example, if the legal reserve requirement, it can simply be called the RR, the reserve requirement, or the legal reserve requirement. So if, for example, the legal reserve requirement is 10%, if the legal reserve requirement is 10%, what happens? Of course, the commercial banks set the legal reserve requirement. So for example, if we have a customer in bank X, if we have a customer in bank X, a customer in bank X, right? A customer in bank X. And this customer, for example, now goes and deposits, let me say 100,000. This customer deposits 100,000 to his bank account with this commercial bank, 100,000. So if the legal reserve requirement is 10%, then it means that the central bank requires this commercial bank X to pay 10% to deposit with it, 10% of this money on every deposit that the clients of this bank make. So for this particular client now, for example, here the legal reserve requirement, if it's 10%, it means that this bank now will have to deposit 10,000. This bank will have to deposit 10,000. 10,000, if this is Ugandan shillings, it will deposit, this commercial bank will deposit 10,000 with the central bank. So that is what we call the legal reserve requirement. So what happens, for example, now, right, practically what happens here is that the logic is simple, that we are looking at two scenarios. We are looking at a period where there is excess money supply, or a period where the economy is experiencing inflation. So in periods where the economy is experiencing excessive money supply, or during periods of inflation, the central bank will work towards reducing money supply. Of course, reducing that money supply to an equilibrium, that we have looked at, to an equilibrium where the money supply should be equal to the money demand, where the money supply should be to actually obtain a money market equilibrium, So in this perspective, when we have excessive money supply, the central bank will increase the legal reserve requirement. The central bank will increase the legal reserve requirement. For example, if initially the legal reserve requirement was 10%, it can even increase it, for example, to 15%. And when it increases this legal reserve requirement, it literally means that now central banks, that commercial banks are required to deposit a more amount of money with the central bank in terms of the legal reserve requirement. The proportion of the legal reserve requirement will be higher when the legal reserve, the proportion deposited with the central bank will be higher when the legal reserve requirement increases. And of course, the whole essence is to reduce the commercial bank reserves. Of course, at the end of the day, this one these commercial banks will increase their interest rates their interest rates on loans that they are offering to the borrowers, and this will discourage the borrowers from borrowing money from these commercial banks. And of course, now this one will work against increasing excess money supply into the economy, right? So that will be that during periods of, that's what the central bank will do with the legal reserve requirement during periods of excessive money supply. Then during periods of low money supply, for example, during periods of a recession, the central bank, or during periods of a deflation, the central bank reduces the legal reserve requirement. The central bank reduces the legal reserve requirement. For example, here, if initially the legal reserve requirement was 10% before a period of recession, it can be, for example, reduced to 5%. And this one means that now commercial banks, for every deposit that clients of the commercial banks make to it, the commercial banks will be required to deposit with the central bank that proportion of money, which will be less, literally increasing the commercial bank reserves. And therefore, these commercial banks will reduce the interest rates, of course, will be reduced by these commercial banks. Of course, the interest rates on loans, and this, when the interest rates on loans given out by commercial banks reduce, this encourages borrowers. It encourages borrowers to borrow. And of course, when they borrow this money from commercial banks, this increases the money circulation. It increases the amount of money supply in the hands of the public. So literally, initially, if the money supply has been low because of deflation, because a period of a recession, now with the encouragement of borrowers to borrow money or loans from these commercial banks as a result of the central bank reducing the legal reserve requirement, this increases money supply. It increases the supply of money in the hands of the public, literally increasing money supply up to that point whereby we shall have an equilibrium. And of course, now the central bank will have regulated and curbed, will have eliminated and curbed the that problem of a recession. So I hope that is clear up to that level. If there is anything unclear or anything that you've not understood, please feel free to raise up your hand and ask. All right, the next tool of the monetary policy, or the next monetary policy tool, is what we call moral suasion. Now, with moral suasion here, it is practically the central bank. Here, the central bank is persuading the commercial banks to adhere to the good credit lending policy. Here, the central bank is simply persuading commercial banks to adhere to the good credit lending policy. Why? Because of course, when this central bank, of course, sets the CBR, the central bank rate, yeah, or the central bank rate, which is the interest rates by which commercial banks borrow money from the central bank. But of course, at the end of the day, these commercial banks will, because they are private banks, right? They are private entities. They are private banks. They are free enough to set their own interests, their own interest rates on their loans. The central bank does not have total control over these banks, because they are private banks, to tell them how much of the interest they should charge on their loans. So these commercial banks, because they are private banks, they can't charge any interest rates on their loans. So literally, the central bank does not have direct control over these commercial banks in terms of determining the interest rates that they are charging on the loans that they are issuing out to their borrowers. So here with moral suasion, because of that circumstance, the central bank will simply be persuading the commercial banks to adhere to the good credit lending policy. In other words, not to exploit these borrowers by charging high interest rates on their loans, issued to the borrowers. So practically, that is what we mean by moral suasion. Let's look at the benefits of the monetary policy. There are basically two benefits of the monetary policy. Number one is politics, in terms of politics. Number two is in terms of speed. So the monetary policy is beneficial in a way, or it's advantageous in a way that it is separated from politics. It is separated from politics because it is the central bank literally that carries out that uses these instruments. It's not the politicians. It is literally the central bank independently that actually uses this monetary policy instrument to regulate money supply. So it is free from politics, from the political process. It's not influenced by politics, right? So secondly, of course, this cannot be comparable to the fiscal policy, which fiscal policy is literally the government itself, which is influenced by political will, that actually, of course, even the fiscal policy is another instrument that is used by the government to regulate money supply. We shall be looking at what the fiscal policy means and how it is actually carried out. But now, since we are looking at money demand and money supply, we are now looking at the monetary policy. So compared to with the monetary policy compared to the fiscal policy, the monetary policy is separate from politics because it is the central bank that uses this tool to practically regulate money supply. It's out of politics. Number two, with the monetary policy is that its advantage or benefit is that it has high speed. It has higher speed compared in terms of course, results, because these decisions are made speedily compared to the fiscal policy that actually depends on politics. Let's look at the drawbacks of monetary policy. It also has drawbacks in a way that it has weakness as an expansion tool. It has weaknesses. Why? Because during periods, it's not automatic that all these measures, all these instruments that are used by the monetary policy, that they will actually be very effective. Yeah, that it's automatic when you increase the bank rate, when the central bank increases the bank rate, when it increases the legal reserve requirement. Yeah, when it increases that at the end of the day that this will automatically make people to borrow money. No, that when it reduces the bank rate, for example, or the legal reserve requirement, this will automatically encourage borrowers to borrow. It may not be the case. So it can be a weak expansionary tool. Then in terms of broad impact, it may not have a wider impact, especially in areas where there are high unemployment rates, in areas maybe of the country where there are unemployment rates, carrying out, for example, of course, the monetary policy has objectives. I'll be sharing the objectives of the monetary policy. One of them is to reduce unemployment. So it's not automatic that when when this central bank, for example, uses the monetary policy instrument to reduce money supply, that it will automatically increase, it will automatically reduce unemployment. No, because we shall later on even discover that with the Phillips curve, according to the Phillips curve, during periods of inflation is when the Phillips curve says that when inflation increases, unemployment reduces. When inflation increases, unemployment reduces. That there is a negative relationship between inflation and unemployment. In other words, during inflation, people get more jobs. That's what the Phillips curve says. So of course, with the Phillips curve explanation, this is even contrary to what the monetary policy will be doing. So of course, with this, the monetary policy might not be effective, especially in areas of the country, for example, where there are unemployment rates. This may not be practical. All right, there ends our session for this particular lesson